Welcome to another episode of our video presentation. My name is Si-Wing Yi from the Year Real Estate Network, and my special guest is once again Mr. Richard Vanny from Supreme Lending. So let's get to the chase. One thing we always are is that Richard and I, we are very realistic. We're very transparent. We don't have a specific market we promote, right? As you know, we are from a global perspective. My organization promote investment properties in many areas of the country, mainly South and Southeast. And Richard Vanny, as an investment loan agent, he does investment loans all over the country. So in all types of loan products. So today, obviously, we can talk about the crucial things that all of you have been aware of: inflation, the changing real estate markets, the challenging aspects of it. And I know there's a lot of negative headlines going on, and they will continue we're gonna see a lot of negative headlines, a lot of doom and gloom situations. If you click on the YouTube videos, you will see a lot of negative headlines. You'll see realistic videos coming from people who are mainly going for the clickbait, so I just challenge every one of you, whether you are a real estate investor or not, is just to just try to be smart about it. Try to understand what information is accurate and what is not accurate. So again, our job is to give you from our experience and our from our perspective, and so you can hopefully just get some value out of it. So as a real estate investor, I know what you're thinking, right? It doesn't have to be. You could be a primary homeowner. We are seeing what's going on, right? We see inflation at the 40-year high, interest rate has skyrocketing in the past 6 months. And so what you're thinking is, what should I do? Should I? Really, you have three choices. One is do nothing. Okay, and if you do nothing, you're not improving your finances. You're not giving yourself the opportunity to increase your financial wealth through real estate or otherwise. So do nothing most likely may not be the best option. And the second option you have is do something about it. Buy real estate, investment real estate or otherwise. You can do it yourself, obviously, right? So doing yourself is very challenging, as we all know, very, very difficult. And the third option is to surround yourself with a team that can help you do everything, that you can scale your real estate portfolio. You can use the services of a one-stop shop, if you will, something that we do. So with that in mind, let's cut to the chase. So Richard Vanny, so we can talk about, as a real estate investor, giving the interest rate, which is very, very challenging. So what are you thinking? What if you put yourself in the shoes of a real estate investor in terms of number crunching, meaning doing your cash flow analysis, right? Looking at the kind of loans you can get. You can do financing at 25% down payment. Let's use a scenario of an investment property costing anywhere from let's use an example of a $200,000 investment property. So giving the higher interest rate loan product for investor you have right now, if you put 25% down payment, can you cash flow? And if so, how much cash flow you can achieve? And not only that, what is your expectation, right? As a real estate investor, I mean, what is your cash on cash return expectation? What is your total ROI, return on investment expectation? So let's go with that, because this is very, very critical to determine whether you want to take action or not, given this challenging environment. So without further ado, Richard Vanny, we'll take it away. As an investment loan agent, how are you going to strategize? How are you going to make a loan product that will work for an investor moving forward?
Absolutely, yeah, it's a good question, especially in this volatile environment. So a couple ways to answer it. I mean, firstly is as investors, we are definitely looking at real estate investments a little differently than we were even 6 months ago. Real estate obviously is a great investment vehicle. And I know typically most of us analyze real estate based on our front end cash flow and returns on the real estate. And that still is important to do. However, more and more of us are now looking at real estate really as a shelter, a shelter and a hedge against inflation, against everything else happening in the market, but also, where else do you feel safe putting your money right now? Mattress money or money in the bank with inflation is losing 10 to 20% a year. The stock market's volatile, crypto market, well, if you like roller coaster rides, you can jump on that one. But if you look overall, where else do you put your money? And what the interesting thing is, we're seeing a lot of new clients coming in that are looking to diversify and protect some of their stock market and or crypto gains or whatever it may be. And the place they're looking for is real estate, the same place where most of us cash flow investors have been looking for a long time as well. So, we have a little more competition from some of those investors, but it really made me start thinking about, okay, well, why do these people with the $10 million net worth now all of a sudden want to go heavy into real estate? And that's when you look at the broad level impact of real estate, especially in a market like now. Now, yes, rates are in the 6% range for rentals, but inflation is at least double that, right? So even though rates are high, they're still a good hedge against inflation. On top of that, if you look at real estate a little more subjectively, then what's my front end cash flow, right? If you really break down the numbers and you look at your return on amortization, right? What you're paying down, your balance down every month with that payment. You look at the hedge against inflation, and also you look at the fact that real estate is long-term. I can tell you from experience, properties I bought 5 to 6 years ago that were making $200 a month in cash flow, renting for $1,400, $1,500 a month. And were good investments back then, right? They were penciling out to meet my desired ROI. Well, those same properties from 1,400 leases are coming up, and I'm seeing this across my portfolio, are renting out for $1,900 a month. My cash flow went from 200 to almost 700. My return went through the roof. And, the longer and longer I've been in real estate, the longer and longer I truly appreciate how it's a wealth builder. It's not a get rich quick builder, right? Even if you make 8% return, which it's going to be almost impossible in this market, but it does exist. See, we actually know some markets that can get you that. But even if you were hitting an 8% return on a $200,000 property, $60,000, $70,000 out-of-pocket investment, what are you going to do with that? It's $200 a month, $250 a month. It doesn't sound like a lot of cash, but it is a great investment to get that level of return. Is that a dinner? Is that a couple drinks? Is that, taking the family out for lunch? What impact does that truly have on your life? Not a huge impact. And I'm not saying get away from ROI. ROI is great. You need to obviously analyze one market versus another and so forth. But, I guess the reason I'm saying it is, you set this arbitrary number in your head of this is ROI I got to reach for it to be a good investment. And I just say, ask yourself, what is that based on, right? Where else are you going to put your money? And then also on top of that, once again, when you look at the broad scope of real estate, when is your exit strategy? It's important to have exit strategies, but is your exit 10 years out, 6 years out? Do you plan on selling the home in 4 years to pay for your kids' college? Do you need to sell it to buy a car? Most of the time, not for 99% of us out there, right? You are investing long-term, and it's very easy for investors to get caught up in the ROI. Well, that's your first year ROI, firstly, right? As you own that property longer and longer, not only our rent's going to go up historically, but that level at which you pay down your loan balance, every payment you make, more of that total payment goes to principal and less goes to interest. So when you have a property 6 to 8 years in, even if you bought it today, 6 to 8 years from today, you're going to be paying out a huge amount of principal with every payment, right? rents would have gone up, plus you're hedging against inflation and you've got a fixed rate. To me and to people way smarter than me, real estate still proves to be a solid place to put your money, especially when you are looking, at the long term. And the last thing I'll say is, look at house prices that our parents paid for their homes, people that bought homes 30 years ago. Just 30 years ago, homes that are worth $1.5 million today were bought for under 200 grand across the board. And did real estate go up from 200 to $1.5 million? Well, yeah, but no. A huge portion of that was inflation, right? The cost of that dollar has gone down dramatically from where it was before. And that will continue to happen. 30 years from now, hopefully we're not in a position where, a small house is $2 million because the dollar is that less valuable as it was. But, inflation's double-digit percent right now. The target is 2%. Even if we're at a 3% inflation rate, right? 30 years from now, that's 90%. That's 100% more that something's worth. So if you bought something for 300 grand today, just based on inflation, 30 years from now, it's probably gonna be worth 400 grand, double. So, look at real estate long-term. The market will do this, the economy will do this. But real estate overall, even though it does a lot of this, it still goes up this way. And have a good exit strategy, be well capitalized, don't be reckless with your investments, and obviously analyze what a good investment is to you. But the overall criteria, we all got spoiled, right? You couldn't lose anything you bought, cash flowed, anything you bought was going to appreciate. So it takes a little more of a lens today to determine the right real estate, and that lens needs to extend beyond the next 12 months. It needs to be the next 120 months. Hopefully that answered your question.
Richard, what a great presentation. You're right. If you want to become a real estate investor, a truly motivated, serious, committed investor, you need to think long term. So every year when you own your rental property, you just have to stay the course. You have to be positive. Don't let all these naysayers, all these negative headlines bother you. You just stick it out. It's not going to be easy. So, Richard, you both of us come from tons of experience in the past 2 decades. So really resonate. I know it's hard. It's easier said than done. Let me share you with the 5 minutes we have remaining, Richard. I will share 3 short slides which will resonate what you just said. So just bear with me. Let me scroll up to slide number 92. Okay, here we are. So what Richard is saying is really, regardless of happening right now, inflation, interest rate, recession, whatever, or this, situation. So the bottom line is up, down, or stable. So what right now? Who cares? We all need to avoid the binary bets. We need to take from a high level, we need to take a multi-dimensional bet. What does that mean, multi-dimensional bet? That means you need to obtain an amazing 30-year fixed rate mortgage, which is the 8th wonder of the world. To me, is the greatest invention in the history of wealth building. If you use this 30-year fixed rate mortgage, the trajectory of your financial future will change forever. And as an investor, when you use this 30-year fixed rate mortgage, it is an inflation-induced debt destruction. It is a very good debt. It'll multiply over and over again, and your family's legacy will be changed forever and generationally. And finally, a income property is the history's most powerful, most proven, most attractive, multi-dimensional real estate class. And Richard had gone over that, right? Richard, you have gone over the cash flow aspect of it, the increasing rent, the depreciation, the tax benefit aspect, which we have not even talked about the long-term equity growth, 5 to 7% or more long-term annual appreciation. I don't know, we don't know the future, but historically speaking, real estate always goes up long-term. So appreciation, same thing as equity growth, and using the power of leverage, using the power of the 30-year fixed rate mortgage is such a powerful vehicle. So really, and then of course, if you buy a property in a good area, strategically, like the one we promote in South and Southwest, you can cash flow at 25 to 30% down payment, even with a 6% mortgage, you can still cash flow a little bit, right? At least the first year. But at the end of the day, it's not all about cash flow. It's all about what we just discussed. An income property is a multi-dimensional asset class. So with the final recap, before we all let you go, so Richard, any final words of wisdom for real estate investors out there, newbie or otherwise?
And the same thing I always say, right? Sitting on the fence. I mean, how many videos have we done and how long have we been doing them, right? People would have listened 2 years ago. Imagine obviously where you would have been today. It is a volatile market though right now. Do your diligence, invest wisely, make sure that you're capitalized and have exit strategies. But historically, when there's turmoil in the markets and there's fear, that's where people capitalize the most. I am still buying. I have 2 properties closing in the next couple months, new construction. I got in contract last year when rates were half of what they were today, right? And a lot of the cash flow I was basing my initial investments on is gone now, right? And so when I said earlier, we need to look at things a little differently than we have been, that's coming from experience, because I'm in that bucket and I am also paying that mid 6% rate, but I'm still buying it because I don't know where else better to put my money right now. And I am looking at the long term. If you want a little buffer, don't put 20% down, put 25, 30, 35% down. Give yourself a little more payment buffer. One thing I can tell you though, pretty definitively, is rents are not going down. They've gone up sharply this year from last year. I've got 22 properties in my portfolio and I've seen it on every single one. And the crazy thing is rent inflation is still to hit, right? Leases are normally written at a year lease. The rate increase and the affordability for a home today versus 8 months ago is way more expensive today, right? So anyone that owns a home is going to increase the rent when their leases come due. Now, rates have gone up in the last 6 months, but leases were written a year ago. Over the next 6 months, as those renewals come due, rates are going to go up, which means the ROI you're basing it on today probably will be a little higher by the time you close and by the time a lot of these leases come due. So yeah, if you have any questions though, obviously reach out to C-Wing, reach out to myself. I'm happy to share my experience with you, not only as obviously a real estate investment finance person, but also as a savvy real estate investor. But yeah, nice to share with everyone again.
Very good, Richard. Yeah, you've been a great resource, needless to say. By the way, on a personal basis, I'm also under contract for a fourplex, a new construction in Texas, and also I'm under contract in Florida. Richard know that. So just like Richard, I'm buying, it's just regardless of the real estate market, you buy, hold for long term, ride out the storm, and just show discipline and positive attitude, and surround yourself with a great team like you, like Richard and myself, and a few other of our partners out there in the marketplace. So yeah, just it's never a wrong time to buy real estate. So hopefully this will help. We'll come back with some more hopefully weekly educational modules similar to this. And thank you for attending, everyone. Welcome again. Thank you so much, and good luck in your financial future. This is Si-Wing Yi and Richard Advani. Have a nice day. Bye-bye.